Structure for tonight's talk. Professional accountant, you always start with a disclaimer that I'm going to talk about this study and what we've learned from it and where it's going to go in the future. You cannot sue me for anything that I say. You cannot rely upon it. If tax is far too complicated. This lecture is purely for educational purposes only. You already had the biography. The important thing on this slide is in red at the bottom. It's the address of my website, where a lot of my previous stuff on Islamic finance is, and importantly, this report that I'm going to be talking about. When I fixed the date of this talk with IIBI, I chose a date which I thought was going to be really safe, and the idea was that the report would have been published but would still be fresh and up to date. Unfortunately, things get delayed. The report exists, it's finalized, it's printed, and tomorrow, literally tomorrow, the Qatar Financial Center Authority will be issuing its press release. The report is already on their website. They've created the website page for it. If you knew the address, you could go and look at it. But I haven't bothered trying to put the address into the slides because it's too long. After a couple of days, you'll be able to find it via my website, which will be the easiest way to actually get it. Or you can go to the Qatar Financial Center Authority and work your way down the menus. So let me go straight into the project, the research project. We were asked to look at how Islamic finance was treated in Middle East and North African countries. Find out what they actually do, then think about recommendations for policy changes, focusing in particular on international transactions rather than purely domestic transactions. I got into this because I responded to an email from Her Majesty's Treasury. They were asked by the people in Washington, the International Tax and Investment Center, to help them to find a researcher. And I volunteered to do this, thinking it was another sort of unpaid activity just because I was interested in it. I even discovered I found there was a small fee. Not much, $5,000, but better than nothing. But I did it because it's an interesting subject. And it has been illuminating. The key thing about Islamic finance is that an enormous amount gets said about Islamic finance on the basis of presupposition. It tends to be an evidence-free zone. And what we have done is go out and find evidence, as you'll see when I talk about the study. So it's sponsored by the Qatar Financial Center Authority. They were working with the International Tax and Investment Center, which is an outfit in Washington that particularly works with tax authorities. They were set up in the early 1990s after the fall of the Soviet Union, and they do a lot of training for tax authorities and advice for tax authorities. Ernst & Young, we're in the right building, were key players in this because the one thing that I did not want to do was to send out questionnaires to 19 different countries and then try to get them back. It's a completely pointless activity. Ernst & Young dealt with all of that. PricewaterhouseCoopers in Malaysia did get involved because they filled out a questionnaire for Malaysia. And I got them to do that for one specific reason, which was that we went to Kuala Lumpur and presented our research efforts at a conference organized by the Malaysian Central Bank. And I thought it'd be nice to have some Malaysian comparatives. But actually, it's provided an integral part of our report as well. I wrote most of the report, along with my co-conspirators, Salah Gwaidi, who is number 2 at the Qatar Tax Authority, and Hafiz Chowdhury from the International Tax and Investment Center. I'm not going to go through all of the reasons why the QFCA is a wonderful place, but they are good people. The MENA region, we got responses back from the people on the left. We got nowhere with the people on the right. And I haven't bothered trying to audit why we didn't get them. Some of them, Palestinian territories, I can understand. They do have a tax administration, but I can understand if they don't have a lot of law on Islamic finance. But all the process of issuing questionnaires and getting responses back was handled by Ernst & Young. And we focused on direct taxation. Capital gains tax, corporation tax, income tax, withholding taxes. The key thing we excluded was VAT and other consumption taxes, and we also excluded zakat. We focused on 4 very common structures that are used regularly in Islamic finance, and as you'll see in a moment, we created a questionnaire where we set out in great detail what was happening before we asked any questions. The biggest danger when you're doing this kind of research project is that people fail to understand the question that you're asking them. And so the more detailed you can make it, the simpler the question that you ask them. Does this payment from here to here suffer withholding tax? The greater the chance that you will get a meaningful answer. And the questionnaires we got back were pretty good. They were very, very usable. They provided meaningful information. So, straightforward commodity murabaha transaction. Important to stress that there is an international frontier, so I drew the frontier on the slide. That's my own perfect sort of ability to draw a curvy line using PowerPoint. And we have an overseas bank. All the other transactions are happening inside the country. And we set out the transaction step by step. Same with an Ijara Sukuk, in this case with an onshore SPV. So most things happen inside one country, only the investors are overseas. And every transaction didn't just have a diagram, it had a very detailed description of the transaction. Here, I've reproduced, you're not meant to read this now, it's hard to read anyway, but we set out meticulously, step by step, exactly what happens in the transaction. Because the person filling out the questionnaire needs to have no area of doubt or uncertainty about what is happening. Similarly, we had same sukuk structure, Ijara Sukuk, something being sold and rented back, but in this case, I had the SPV and the investors offshore, only the sponsoring company was onshore. But I wanted to know if there were different answers, and indeed there were different answers in some countries. Salam transaction, often used for forward sales of goods. I mean, for example, you may have a farmer who's going to produce some agricultural output in 10 months' time, but he needs paying now. Somebody else wants that future agricultural output, hasn't got the money to pay the farmer direct. If the customer could pay the farmer direct now and get the food in 9 months' time, you wouldn't need the bank. The bank is there providing the finance. So we have a transaction between the bank and the farmer, and then we have another transaction between the bank and the end customer. And we want to analyze the tax effects of that transaction. Similarly with this ISNA, where you've got a construction company, it's going to either build a building or build a ship or something big that takes time. They need paying up front, long before they deliver the ship. Again, you have a customer, but this customer who wants the ship hasn't got the money to pay to make the installment payments. If the customer could afford to make the installment payments themselves, you wouldn't need the bank. It's the bank's job to make the forward payments and then have some kind of payment arrangements with the customer. So we have two back-to-back ISNA contracts, one between the bank and the person doing the construction, the other one between the bank and the end customer. And again, we made this international. The customer and the construction company are in one country, the bank is in a different country. And then we had in our questionnaire 68 very specific questions, such as, is this payment subject to withholding tax? And for each of the structures, we asked questions which were in particular areas. These are not quotes from the questionnaire. The questionnaire was much more detailed, but I didn't see any point in reproducing verbatim what the questionnaire asked. These are the topic areas that we were asking about. And is the payment tax deductible? Never assume that something is going to be tax deductible. If you tried doing a murabaha transaction in the UK before the UK started changing its tax law in 2005, my view is that quite probably it would not have been a tax deductible transaction. Critically, are you creating a taxable presence in this country for the foreign bank? So if you go back to the murabaha transaction, something gets sold by one person to the bank, and then it gets sold to somebody else, and the original owner and the final owner are both in country, the bank is offshore. Is that a taxable presence for the foreign bank in this country? Are there withholding taxes payable? Do treaties make a change? And transfer taxes. Similarly, with the Ijara Sukuk, we've got a sale of the building from the original owner to the SPV. What are the tax consequences of that? We've got rent being paid by the owner to the SPV because the SPV is going to rent the building back to you. Again, it's easy to assume that a payment is tax deductible, but you can't be sure if it's going to be tax deductible. In particular, we made our transaction slightly more complicated. If I go back to the diagram for our sukuk, we sold this building to the SPV for 100. Original cost 20. So, and the reason for making that clear was that there's a gain of 80. Does that gain get taxed? The building is 100. It then gets rented back to the owner for a rent of 5 every year for 5 years. But then the sellback is not at a price of 100. I made the sellback at a price of 110, I think. I wanted to know, does that gain of 10 in the SPV get taxed? So we really dug down quite deeply to the details of the transaction. We didn't ask questions about accounting, just purely questions about tax. Is a particular item taxable or is it not taxable? And you need to know things like that to try to figure out if it's feasible to do these transactions in that country, or are the tax costs completely prohibitive? What about the payments that you're making to the investors? Is there withholding tax? If the SPV is offshore, then probably not, because it's already offshore, but then you might have withholding tax on the rent going from the original owner to the SPV. If the SPV is onshore and the investors are offshore, you might well have withholding taxes. What happens if one investor sells sukuk to somebody else? Is that transaction taxable in the country where the building is? Because legally, a sukuk is a part ownership entitlement of that building which is in that country. Does that country want to tax these foreigners when they're selling that piece of paper from one foreigner to another foreigner? A whole range of questions. Similar questions for the Salam transaction and for the Istisna transaction. So where are we up to? Well, I told you that earlier. We've done the questionnaires, we got back responses for 8 countries, and I was disappointed to only get back 8, but we learnt a lot from doing it. And also, we've got a questionnaire for Malaysia. I didn't bother filling in a questionnaire for the UK because I know the answers for the UK anyway. And that knowledge of the UK has also informed the way that we've written the report. And the report, it says here when I create the slides being printed, it is definitely printed. I've been assured it's there, it's going to be mailed out to people tomorrow. The press release, as I said, hits the newswires tomorrow. What did we find? Out of all the countries surveyed, only 1.5 has legislation for Islamic finance. Turkey has rules purely for sukuk transactions and only if the SPV is onshore in Turkey. If the SPV is offshore, the Turkish rules don't apply. The other place that has rules is the Qatar Financial Centre, which is pretty good since they sponsor the study, but nevertheless they filled out a full questionnaire for the Qatar Financial Centre as part of this study. The rest of Qatar doesn't, although it's a relatively sort of tax-free zone anyway, most of it. Other than that, none of the MENA region countries have any rules for Islamic finance, despite the fact that, the ones in the survey, despite the fact that some of them now, for example Egypt, have been ruled for quite a while by a governing party which holds itself out as an Islamic party and wants to encourage Islamic finance. Similarly, Libya has been ruled by essentially a Muslim political party for even longer than Egypt, I think. But they don't have any effective rules for Islamic finance. A country that is not in the study, Tunisia, I understand does, but since we didn't have a questionnaire for them, there's nothing about Tunisia in my report. What did we find in terms of the structures? First of all, in some countries, you just can't do this transaction internationally. In Libya, you're not allowed to have a foreign bank buy something in Libya and sell it to another Libyan. Just against the law. almost everybody will give tax relief for the finance costs. In fact, when I say almost everybody, I mean everybody. Every questionnaire is quite clear you get tax relief for the payments. However, there isn't complete clarity about when you get the deduction. So let's say you do a murabaha transaction that is 18 months long. So transactions happen today, and in 18 months' time you're due to pay 110, and of that 110, 10 is really the finance cost, and it covers an 18-month period, and your accounting date is going to be 31 December 2013 before you get to the end of the 18 months. Is that finance cost of 10 all taken in February 2013, the day you do the transactions, or is it spread on a time basis over the 18 months, so you get 11/12 of it in this 2013 accounting year? There isn't any great consistency about what you get, although we did have sufficiently detailed answers country by country. So the report says in Libya this happens, in Egypt that happens. I said only Turkey and the QFC have specific rules for sukuk, but there are a lot of other exemptions lying around. So in Kuwait has taxes, but they don't apply these taxes to companies that are wholly owned by other GCC shareholders. And of course that obviously also Kuwaiti shareholders as well. But apart from odd exemptions like that, in most of these countries, as I said, apart from Turkey and the QFC, if you try to do a sukuk transaction, the taxes kill you. It is just utterly infeasible to do a sukuk transaction because the transfer taxes, the crystallization of built-in capital gains, the charging of more capital gains later on is just infeasible. Some countries have done sukuk transactions like Saudi Arabia, but I think that's a function of either special government dispensations or just absence of local taxes. If you have a country that doesn't tax gains anyway, it doesn't matter if something technically crystallizes a capital gain. But the overwhelming message is that the tax systems of these countries are so unsophisticated that they simply haven't thought seriously about Islamic finance, despite the fact that the governments talk about Islamic finance all the time. Now, Malaysia and the UK, both of them have dealt with Islamic finance in a serious way. They have addressed the tax issues, and they have basically equalized the tax treatment of Islamic finance and conventional finance. Not totally equal. I can tell you about the UK in great detail to find out where there are differences. But essentially, if you want to do a serious Islamic finance transaction in the UK, you can do it. But they've done it in completely different ways. In Malaysia, the key message is that you have to have government pre-approval of your Islamic finance transaction. Not necessarily specifically, because they have standardized transactions. If you do one of these standardized transactions, it's approved. So they know what an Islamic finance transaction is, and they've defined it. And if you fall inside that official government definition, you get some favorable tax treatment. And the Malaysians, being a Muslim majority country, they're not afraid to openly recognize Islam and put it into their tax legislation, as we'll see. The UK, a completely different approach. UK is fundamentally a secular country, despite having an established church. In practice, we're pretty secular. We do not want to have religion in our tax code, and our legislation is therefore religiously neutral. So, as I said, in Malaysia, you first of all get regulatory approval, your transaction qualifies as Islamic finance, and then you get the neutral tax treatment. And I've got some examples here from Malaysian tax laws. So just read the first paragraph. We'll skip over the others. Provided the transaction is conducted in accordance with the principles of Sharia, that's the Malaysian spelling for Sharia, it qualifies for tax neutrality. And incidental transactions don't get taxed. That's how they achieve tax neutrality in a very simple way, because they first of all are clear what an Islamic finance transaction is, and then they legislate for tax neutrality. The UK approach is completely different. The UK looks at what Islamic bankers do, it analyzes those transactions in great detail, and then it finds a way of reproducing those transactions in normal law without any reference to Arabic, without any reference to religion, and in purely religiously neutral language. So I've got an example here. This is a murabaha transaction, except of course they don't call it murabaha, they call it purchase and resale, non-religious language. And you've got two parties, the first purchaser, the second purchaser. Somebody buys something, an asset, sells it to the second purchaser. The second purchaser gets a delayed payment. You work through that transaction, concentrating on the red bits, and you'll see that it is a murabaha transaction. And then you set out some tax consequences for having this transaction take place. So you allow the price difference, you get it treated as if it was interest for tax purposes. But the important point is you achieve that without any reference to Islam or Islamic finance. The disadvantage is that it takes a lot more drafting, a lot more words, it's a lot harder to draft, and you can end up with things that don't make sense to anybody apart from tax lawyers. Now, similarly, I said commodity murabaha and Malaysia both get to the same answer. They both get to tax neutrality, but they get there a completely different way. Similarly, with the sukuk, with an onshore or indeed an offshore SPV, you get to the tax neutrality. Both for UK and Malaysia, if we go back to our original example, owner has something, cost it 20, present value today is 100, sells it to the SPV for 100, rents it back, pays rent of 5 every year for 5 years, then buys it back for 110. The sale to the SPV, the sale back from the SPV suffers no transfer taxes, even though we have a big, expensive stamp duty land tax in the UK. You get an exemption from stamp duty land tax. The gain of 80 that the owner makes when selling to the SPV does not get taxed. The gain the SPV makes when it goes back to the owner does not get taxed. Malaysia also gets to those same answers for tax purposes, but they get there in completely different ways. Now, policy recommendations. This really illustrates the benefit of looking not just at what the Middle East and North Africa does, not just being familiar with the UK, but having a really good look at Malaysia. I mean, I knew about some of the Malaysian tax law before, but when you're really forced to sit down with it and look at it in detail, it helps. The Malaysian model is far more appropriate for the Middle East and North Africa than the UK model, for several reasons. First of all, we're talking here about Muslim majority countries. Every one of the countries, even Lebanon, has a meaningful Muslim majority, I think. Certainly all the other countries, overwhelming Muslim majorities. Egypt, 92%, most other countries it's 99% or something like that. So these countries do not have a problem with recognizing Islam in their legal system. If you can have central certification of Sharia compliant transactions, which actually these countries generally don't. None of these countries, as far as I'm aware so far, although we haven't looked at Sharia governance, we will do in phase 2. But nevertheless, it's fairly feasible to set up a central certifying authority for Islamic finance transactions to say what is a Sharia compliant Islamic finance transaction, and then the drafting the tax law becomes pretty straightforward. We looked at the Malaysian tax rules. It doesn't have to be much longer than that for any of these countries, in my view. If they tried following the UK approach, it would take forever, because you've got to define the transaction in such great care. Where are we going with this study? Assuming we can get sponsorship sorted out, etc., we would like to have a second phase where we would, first of all, include the countries that are so far missing, because the countries that were left out, when we presented this in Oman, they all said, why are we not there? So our plan is to include them and look at other structures potentially, but in particular, we want to focus on consumption taxes, VAT and other consumption taxes, because unless you can make it work for those taxes as well, you've still got a problem. If you want to do a sukuk and you get clobbered for VAT, then you can't do a sukuk effectively. And we want to address zakat. When we presented in Oman, we had some very useful comments from the floor from the Saudi tax administration, because they have a government department that is responsible for tax and zakat, handled by the same department. And again, you need to figure out how zakat should be applied for Islamic finance transactions and try to get a model that works, at least in country, so that a conventional finance transaction for that country and an Islamic finance transaction for that country get the same zakat treatment. It doesn't matter if a different country has a different treatment, because countries don't have to be the same, but at least in country you want neutrality between conventional finance and Islamic finance. Closer look at double tax treaties, and we also want to move on to look at how you regulate Islamic finance. Should Islamic banks be regulated in the same way as conventional banks, or do you need different regulations? The UK model is quite crystal clear. The UK regulates Islamic banks identically to conventional banks, because the UK does not have a concept of an Islamic bank. There's no such thing as an Islamic bank in the UK, there are just banks. And if a bank wants to be Sharia compliant, that's up to the shareholders and the management, but it's nothing to do with the regulator. And we want to look at Sharia governance and what models these countries apply for Sharia governance. I've got a gut feel, which is that they don't apply a model at all, but nevertheless, let's go there and look at the facts on the ground. Because what makes this report so valuable is the fact that everything we say in this report is based upon hard facts. We don't make any comments about countries that are not covered by the questionnaires. The questionnaires were very detailed, and therefore we can say meaningful things about what happens in those countries. And in fact, I've finished ahead of schedule, so plenty of time for questions.